Okay, now we're trying a different mic, laptop computer. We'll see if this works. So I had a couple of, Rosemary's, and then Liza's stuck on the first three questions. So I'm going to go again. I'm going to go into Canvas and go through some of the homework, just so you can see it live again. And I'll post this on an announcement and in the discussion tab. If you're not aware, we have a discussion tab here, and besides welcome to class and that, which I can see almost everybody got going with that, and I'm going to read these later, hopefully. There's another discussions tab, which is the 121 discussion board, and I'll check this and respond as quickly as possible. If you want to ask your question here, then I'll post here and get after it that way. So McGraw Hill Connect and my section. Then we'll go through chapter 1 here. Here's chapter 1's homework. Now again, we're manipulating what accounting, what Pacioli came up with, the accounting equation, assets equals liability plus equity. It's going to make you do a little algebra, and switch the equation around so that you get comfortable using it all the time, different ways. So in the case of 1A, what is the amount of equity at the beginning of the year for company A? We have assets up here of 37,000, liabilities of 30,340. That would give us equity of 6,660. 37 minus 30,340. Here's B. You had this 6660. That's a bad number in your equity from the beginning of the year, and so this is how you get your equity at the end of the year, right? You from the book you add stock, so you issued more stock, right? You get 6,000 more shares of stock, $6,000 worth. 9740 was the net income created during that year, and that gives us $22,400 less our cash dividends. So our equity at the end of the year is $18,900. And then in requirement C, you had to use that $18,900 in the equity box here in order to get your liabilities. So I know I put this on another tape, but again, here's the explanation for you if you missed it. Okay, so let's go to number 2 is down here. Sort of the same idea, but compute the amount of assets for company C at the end of the year. If you didn't know, you can grab this information and drag it with you. If that makes it easier. And I'm not sure it's going to work for me, but well, maybe. Oh, that's question 1. Duh. I want it down with question 2. So I kind of brought it with me. I can stick it over here, I guess, or something. 2 screens is where it's at. So it always tells these 3 items, 3, 4, 5, are right down here. Item 3, compute the amount of assets for company C. Well, how would I do that? Here's company C. End of the year assets So I had beginning of the year assets 23, 12,787. Right, there's company C, and equity 10,893. So that's my beginning of the year and equity. So I put it in there, and then I add my stock, get my net, and add my net income, and then subtract my dividends to get my end of the year equity, which is 20,168. So 4, same trick. This company D, you can see it here, right? You got a question mark with stock issuances, so you got to back into the stock issuances, and we'll do these in class if you'd like. So here's the explanation for company C and the explanation for company D and company E. So if you have trouble there, stop the tape and look at it. Now let's go to 3 and 4. Here we go. Now we're doing the same kind of thing. I'm just having you do it over and over. Like I told you at the beginning, this is just a redundancy kind of thing. Practice makes perfect. So in 2A, what's the amount of equity at the beginning of the year for company B? Here's company B, right? What is the amount at the beginning of the year? 34,000. And 21, it didn't give you any equity, but it gave you assets and liabilities. So assets equals liabilities plus equity. So assets minus liabilities equals equity. You just switch in, use a little algebra. This one, what's the amount of equity at the end of the year for company B? Same question, ends up being 13.5. Your numbers will be different again. Here's A and B. Right, beginning, ending. C looks like that. Terrific, right? Add stock, net income, subtract your dividends, and you end up with equity at the end of the year. Here's what it looks like trying to solve for net income. All right. Question 4. 24, 9, 15. Again, you saw this question in number 2, I think, number 2. What are the amount of assets for company C at the end of the year? And we've got this one. Company D, amount of stock issuances. Oh, what a pain. I got to back into that. And here's number 5. The amount of liabilities for company E. Now let me give you this is number 4. So let me give you the explanation there, right? So you make a big equation out of this, and I'll do it on the board. I don't have drawing abilities now, but I'll do it on the board for everyone if you're still confused. You're just going to convert this into an equation and get instead of a question mark, you turn that into X or whatever variable you want and go from there. So let's go to number 5. Company E, 4, company D, company C. 3, 4, 5. All right, and this one you had to figure out the equity. So that should do it, I hope. You can stock the tape wherever you want on those. So let me see, 3, 4. Yep, that's that. and 5. Look at all this information we have. We have to make a statement of retained earnings out of all of this. So we're beginning to classify where these things go. It's trying to get you to figure out where things go. And on an income statement, it's merely revenues minus expenses. Here's your solution down here, an explanation of your solution. So you take all your revenues and you take all your expenses and you put them in this kind of format. And that's what it ends up looking like. Our net income is $16,300. So our retained earnings from the prior year, $4,300. And then we had some dividends. So our retained earnings for the following year is that amount. It's kind of a little more difficult, but I'll show you again how to do it. Here's number 6, same idea. And there's the solution there. Beautiful. And number 7. There's the Graham Company completed the following transactions. These are one by one transactions. You just do them all like this. Here's an income statement, right? Rent. Here's the revenue, and here are the expenses. Retained earnings here. Balance sheet here. All right. And statement of cash flows here. All right. I bet that was a lot, but we can go through it again just to nail it home. 8 of 12. Same problem except different. Got all these things that happen. These are economic events. Enter each amount of each transaction, individual items on the accounting equation. Right? Assets equal liabilities and equity. This gets you to begin to think like an accountant, right? What happens to cash? We've got accounts receivable, we've got equipment, we've got accounts payable, those are liabilities. Common stock is equity, revenues is in the equity equation, right? Account titles for these expenses are down here, and look what we end up with. It looks harder than it is, but again, I know if you're brand new, it's kind of freaky. We'll go over it again. Here's 9. Same question. Right, and you go one by one. It seems really complicated, but it's not too bad once you get going. And requirement 2 is our net income. What was it? Right down here. Here's how you get net income. 68 minus 23. 68 minus 23, that's revenues minus expenses to get net income. 6,800 minus 23 is 45. And that makes sense, if you're mowing lawns or anything else, revenues minus expenses. 10. Again, same idea. Just get you to do it over and over again. Ooh, this is big. Big, and it's giving you a cash balance all the time. Let's see what you got for cash. 9,100 minus 30. Let me put this up so you can see it. Oh, I can barely get it in there. That's the date. assets, liabilities. And again, there's our question. No further explanation needed there. And did it ask us another question? I don't think so. 10, and then 11 and 12 are here. Kisera manufactures, markets, and sells. The average total assets 241. The most recent year 61, and revenues and net income of 61 and revenues of 469. Does ROI, right? Here's 11. Wants you to do ROI. Our return on ROA assets seems satisfactory for the risk involved in manufacturing, marketing, and cellular phones. A 25% return and more than twice as high as its competitors, 10%. Yeah. Satisfactory, yes. And question 12, what's the average total amounts of liabilities plus equity for Kisera? And here's the explanation down here. And it ends up being 241, right? Finance liabilities plus equity must be total for assets investing. So, right, so total average total assets are 241. Okay, that is chapter 1, and God willing, I recorded here, and I'm going to put it up for you just as soon as I get it downloaded.